Welcome to Fideres' inaugural webinar. Today we're talking about some issues, uses, challenges surrounding the use of event studies in securities fraud claims. My name is Max Theiler. I'm a director here at Fideres. I've led a lot of work involving this sort of methodologies and event studies, damage calculations around securities fraud claims. Just to give you a quick overview of what the webinar is going to cover, first we're going to talk about some background on what securities fraud is, what an event study is, in the context of a particular case, the Stamps.com case. This is a sort of a nice intro, just will give you some background on what we're going through here. And then we're going to talk about some of the issues that arise in using event studies for securities fraud claims and the way that we approach these issues here at Fideres. So to begin with, just some background. There are two basic kinds of securities fraud cases. Both arise from an omission or a misrepresentation. So the sort of simpler and rarer form that we're not going to deal so much with has to do with misrepresentations and omissions around sort of certain corporate events, such as an IPO or a merger. This is a fraud related to some documents that were produced in relation to this event that were sort of erroneous. This is relatively more straightforward than the second kind that we're more interested in here, and that's a Rule 10b-5 securities fraud claim. So this has to do with continuing disclosure obligations. So these sort of claims arise when the CEO or management fails to disclose to shareholders some sort of crucial piece of information that has an effect, material effect on the stock price, equity prices. So this failure to disclose in compliance with Rule 10b-5 as required by law results in an inflated stock price. And so anybody who's buying stocks during the period in which this disclosure has not been made, and it should have been made, is effectively being defrauded. And the sort of size of damage that they've sustained financially from that fraud is sort of the challenge that we're going to be talking about today. So again, we're focusing on 10b-5, sort of the much more widespread, more interesting of the two here. So to give you an example of what sort of securities fraud looks like in practice, this is a very clean, basic example that we picked. This is surrounding a company called Stamps.com. So Stamps.com on February 21st announced that it was unexpectedly discontinuing its exclusive shipping arrangement with the U.S. Postal Service. So prior to this, it had sort of been understood by investors and shareholders that Stamps.com was going to have this specific sort of exclusive arrangement with the USPS. And then on February 21st, it came out that it wasn't going to. So obviously, this understanding was responsible for a fair proportion of Stamps.com's share price. And you can see that there's a very clear, clean drop. So there's, on the moment that this information came out, the share price of Stamps.com drops from, somewhere around $200 per share to about $100 per share. So it lost about half of its value overnight. We've recorded this up sort of in the top right-hand corner, the share return minus 54%. That's the loss in value that occurred on the moment of the disclosure. And that's effectively is kind of a starting point. That's the number that we're dealing with as the change in share price as a result of the disclosure. That's the artificial inflation that existed in the share price prior to the disclosure, and that's what the share price lost when the disclosure was made. We've got another number up there, log return. That's a sort of a mathematical transformation of a normal return that is used in sort of calculating time series math. I don't think it's that important that we go too much into how logs work and what log return means. It's sufficient maybe to say at this point that the intuition of log returns is the same as it is for normal returns insofar as a drop is a drop, larger drops are bigger than smaller drops, et cetera. So if you're not really sure what logs are, don't worry too much about that. But if you see that going forward, that's just intuitively the same thing as normal returns or changes in share price. So anyway, carrying on to sort of Stamps.com example, we've got this big dramatic drop in share price, and we know that much of this has to do with this disclosure, this omission, this failure to inform shareholders that this partnership with the USPS was not actually happening. So there might also be other effects affecting the price as well. So we've got here another sort of just simple toy example with the Stamps.com. We look at a sector that the Stamps.coms belong to in the economy, and we say, what is sort of a market index that represents that sector doing at the same time? And in this case, we see that actually that sector went up about 1.4% in share value at the same time that there was this drop. So the drop that we see from the disclosure isn't the entirety of the inflation, or rather the entirety of the artificial inflation due to the non-disclosure of the end of the relationship with USPS. There was also a bit higher loss because the market was sort of pushing the stock up at the same time. So the drop is even more dramatic than just the nominal level would make you sort of think. So this is a relatively simple arithmetic. We simply say, okay, well, if there was a negative 86% log return drop in the share price, and there was a 1.4% log return increase in the sector index, then actually that share price is the sum of these two. So the real loss, or the real drop in share price, the real amount of artificial inflation, is given by that 87%, which incorporates both the changes in the market share price and the log return itself on the day of the disclosure. So there's a couple other aspects of share price that are kind of need to be separated out before you can arrive at a pure artificial inflation. That market index thing is only the first one. So we've got another kind of toy example here. We're moving beyond stamps.com to sort of some made-up numbers that help illustrate this a little better. So on the far left-hand side of this diagram, we've got the actual decline of share price. So imagine that share price has dropped by $10. You can observe that the price per share is $10 lower on the same day that a disclosure happened than it was before the disclosure. And suppose you've done that first thing that we just spoke about on the previous slide. You separated out the market and industry movements that happened on the same day. So in this case, perhaps you've seen that the market index actually dropped about 15% or whatever on the same day. And so you say, okay, well that's fair enough. Maybe 15% of that price drop wasn't really caused by the disclosure. It was caused by sort of ambient movements in the market. So you can separate that out. The second factor that kind of needs to be looked at, and the second piece of this decline in share price that we separate out, is this 90-day look-back adjustment in yellow, which is kind of in the middle of these bars. So this is required by law in calculating these artificial inflation figures, and it's basically a way of accounting for the idea that perhaps the actual observed decline in the share price at the moment of the disclosure was a bit of an overreaction, or was sort of overstating the actual effect of the disclosure. So it's possible, there's sort of some panic. Maybe stamps.com maybe isn't such a non-viable company as some of these shareholders were thinking it was. The share price goes up a little bit in the next 90 days. So if you just take the average return over the next 90 days and you say, okay, well, suppose we've had a $10 drop in share price, but we've gone back up 30 cents in the next 90 days. Maybe that 30 cents was just 30 cents worth of overreaction. So we can separate that out from the artificial inflation as well. That 30 cents was not part of the sort of overpricing that people were paying before the disclosure. The third piece of the picture here that we have is this green box. So this is a little trickier, but also quite important. This is the sort of non-fraud related company news that comes out at the same time. So this isn't part of the same sector. This isn't saying this is what the general market movement was around the disclosure, and nor is it saying this is like something sort of wrong with the reaction to the disclosure. This is purely other information that came out simultaneously that might have had an effect on price. Normally, for this sort of a calculation, you have to rely on analyst estimates of what a sort of company's fundamentals are suggesting about it. So the way that this comes up frequently in these 10b-5 disclosures is if a CEO is on a shareholder call and is sort of describing a bunch of financial information that's causing things to change, and then the bomb drops, the disclosure comes out, and there's a big shift. If you can see that sort of prior to that bomb dropping, there was, maybe price was going down in response to the CEO's comments by, say $1.70 in our example case here, then you can sort of safely say, well, that really wasn't part of the artificial inflation either. That was just sort of baked into other assumptions about the company that maybe they were indeed disclosing properly. So you can also strip that out, and what you're left with after sort of dealing with these components is something that is, as I've been referring to it, artificial inflation. This is the amount that we can sort of safely say the share price was inflated by at the moment of the disclosure, and the amount that investors were overpricing that share price, that equity price, on the basis of the sort of fraudulent information they had, which was that there was nothing that they didn't know about, that nothing had been omitted. And then when the disclosure occurs, this drop is what gives you this artificial inflation once you've made these adjustments. So from this point, we now, if we've been sort of following these steps and applying these calculation methodologies here to get our artificial inflation number, we now have what might be termed a quantum. We have a figure which gives us the amount per share that the overpricing was. And so the next step is to move to damages. How much were you actually harmed by this fraud if you were holding shares? So if you have actual sort of records of trading data and you know how much you bought and when you bought it, then you're in luck, and you can do a very kind of prescribed, formulaic way of calculating damages called LIFO or FIFO. LIFO is last in, first out. FIFO is first in, first out. These are very formulaic approaches. We're not going to go too much into them. There's a sort of example on the slide there about how this is done in table form. But the kind of harder and more interesting problem that we often find ourselves in is a sort of macro approach where we say, okay, well, we don't have client trading data maybe for somebody, or we're trying to figure out how much was everybody harmed, how much did this disclosure hurt every single investor, who was actually buying this overall. And that's a much trickier problem, especially sort of at the early stages of an investigation into a disclosure event, because you want to have a good sense of how big the class is and how much damage there might be out there, but you don't have everybody's trading data all the time, so you can't just sort of crunch the numbers. You have to make some guesses, do some estimates. And so the sort of standard way of doing this, and the way that we generally sort of use, is a trading model, which we're going to talk about in the next section here. So, right, first issue, first problem in event studies for purposes of estimating damages and fraud claims is, how do you get class-wide damage estimates? So we don't have the complete trading records of an entire class, and this is something that we especially don't have at the early stages of an investigation, and we're not even sure if it's worth pursuing this. So we need to do, we need to guess, we need to do some estimates. The first approach is this trading model that I've been discussing. There's different kinds of trader models. There's the single trader model. There's multi-trader models that imagine that there are different kinds of traders. For example, buy and hold traders versus kind of very active day-to-day traders. So let's sort of jump into this approach A before I start talking about the other way. The trading model approach basically says we're going to imagine that there are so many traders of a certain kind and so many traders of another kind, and we're going to take a bunch of kind of input data that's publicly available about sort of the history of the share, so that share prices over time, how much trading volume we can see based on sort of public data, the ratio of investors who are kind of buy and hold flow to sort of active traders. There's a number of factors that get built into this, many of which can be sort of observed publicly, but many of which have to be kind of inferred or estimated. So you sort of throw all these sort of assumptions and starting points into the pot, and you actually simulate trading. You say we're going to run this through a computer and have it sort of pretend that it was trading over the course of the class period. How much would it have bought, based on these assumptions? And that gives you kind of a sort of starting point or an estimate for saying how much you think that the actual trading was. It turns out, for this approach, the most important parameter, the biggest assumption you make, the one that really drives how large your damages are, and the one that sort of is most variable depending on what your assumptions are, is the question of floating stock. So I've been sort of hinting at this, talking about these active versus non-active traders. Floating stock is essentially the proportion of the share that is sort of being actively traded at any given time. So if there are large institutional holders, perhaps a pension fund or somebody who's not particularly interested in sort of engaging with the market day to day, they just want to hold on to their stock and let it sort of accrue in value. They're not really trading very often. That's not part of the floating stock. That's sort of sitting to the side, and they don't react to big changes in price. So they are sort of, it's important for the multi-trader version of the trading model to know how many of your traders are doing that versus how many traders are, trading all the time, reacting quickly to changes in price, reacting quickly to new information, and just choosing that bifurcation, saying, oh, I think 20% are holding for long term and 80% are trading all the time, or maybe you think 60% hold in long term and 40% trade all the time. That assumption right there drives, in a large part, the damages that you get for this class-wide estimate using the trading model. So how do you get that split? How do you figure out that number? It turns out that Bloomberg actually reports it. Bloomberg has a calculation here. So you can see this is a Bloomberg screen. We've just sort of screen tapped here, and sure enough, for a single price time series, this is stamps.com again, they report, a floating share. They say here that it's 95% of the shares are floating. So 95% of these shares are being actively traded, and only 5% are being held sort of in reserve. Our experience with this and our knowledge of the way that Bloomberg calculates this number makes us think that this is actually an extremely high estimate of floating share. They use a very, very conservative definition of what it means to be a kind of buy and hold investor that's based on very legalistic premises. So the number that you're getting with that 95 is, we think, not very realistic. So on the one hand, if you want to use that number for this calculation, for this type of modeling, you have kind of the comfort and support of knowing that your number is printed on Bloomberg and, it's the financial equivalent of being etched in stone, I guess. But on the other hand, you might not actually wind up with a very accurate estimate of classified damages because, it's likely that a much larger proportion of the shares aren't really traded that often. And of course, it's something of a gray area, right? What does it mean to be active and non-active? It's not a perfect binary. But to say that 95% of the shares are being traded constantly and 5% are not is we think, far too conservative an estimate of the percentage that are not being traded very often. So we prefer to calculate this ourselves, and we prefer to find this by looking at quarterly holding reports. So we say, if we're looking at some shareholdings of the major shareholders for the share that we're looking at, the equity that we're looking at, and we say how much actually were these holdings changing around over time, we can kind of back out from those shifting numbers our own version of a float percentage. And that proportion that we get, for example, for stamps.com is more like 45% instead of 95%. So it's actually fairly different from what Bloomberg reports. And we think, a more accurate damage estimate is going to come out of using this slightly less strict number. On to the next slide here. So the second approach to getting class-wide damages, I sort of alluded to this earlier, is rather than trying to build a model and simulate these floating shares, or perhaps using Bloomberg's floating shares, is to actually go look at the quarterly holdings data directly. So if you've got your sort of share in question pulled up on Bloomberg, as we have here in this screen cap, you can see that the sort of major shareholders are sort of listed here, and you can see quarter to quarter what their holdings are. So for example, if you look on the sort of BlackRock Incorporated row on 2018 Q3, there's 2 million some holdings. And then if you go to Q4 2018, there's 2.6 million, so they've gone up 600,000. That shift and the shifts that you can see all through those columns tell you something about buying and selling. So as a very crude assumption, you might say, okay, well, I'm going to look at this information and infer that BlackRock bought 600,000 shares of this stock in Q4. That might seem sort of sensible on its surface, but the problem with that is that this data is not very granular. This is just giving you a snapshot at the end of the quarter. So they may well have sold 1 million and bought 1.6 million, and you would still wind up with those same numbers. But that would be a very different sort of total amount of buying of the share, and you'd have a very different sense of what your actual, class-wide buying was, and hence class-wide damages. But nevertheless, despite this sort of crudity, you can still get a fairly reasonable high-level estimate by saying, here's what we see in terms of quarter-to-quarter shifts in holdings among the top shareholders. I say top shareholders frequently. All shareholders will be present on Bloomberg, or at least such a large proportion of the outstanding market cap that it's effectively all. So if you're willing to kind of tolerate this quarter-to-quarter imprecision in terms of the granularity of your data, you can actually just sort of model some buying directly from this data and then apply your formulaic LIFO-FIFO approach to get sort of a standard kind of damage estimate. So sort of a summary of this section and this sort of class-wide damages problem, we've got here just sort of a breakdown which shows you, like, okay, if you're using this trading model, you actually get fairly different numbers depending on whether you use Bloomberg's reported floating percentage or whether you use that 45% that we calculated. The interesting thing that we kind of wanted to highlight with this slide is that the two modeling approaches, the trading model and then just doing this quarter-to-quarter holdings analysis, actually puts you in reasonably close proximity to each other. You kind of get in the same ballpark, at least the sort of stamps.com toy example we've done here. You're kind of somewhere in the upper 100 millions. The fact that you can arrive at this from two different angles does give you a bit of comfort that you're kind of getting close to what's might be sort of a reasonable approximation of classified damages, even though you've done all of this without any actual trading data and haven't been able to apply your LIFO-FIFO. So that kind of summarizes the sort of classified damages issue that we wanted to talk about. Bottom of this slide is just sort of an overview of kind of the pros and cons of either method. But again, I think the sort of comfort comes from being able to do both and being able to say, okay, well, we're honing in on it. We're getting close to the range. We know we're somewhere in the upper 100 millions. So this brings us to the second issue that we want to discuss in terms of applying event studies to securities fraud, and that's what to do when your counterfactual price goes below zero. So returning to the original slide that we first showed, here's again the the stamps.com drop in share price on the day of the big disclosure. We haven't shown the sort of all the different calculations that you do for the look back and for the market movements, but just imagine that they weren't that significant. And you've got this counterfactual price there, and it's the dotted blue line below the orange line. That's what we're kind of arguing the share price for stamps.com should have been if this disclosure was made earlier. If they hadn't waited until the 21st of February to reveal that they didn't have this exclusive arrangement, the share price would have been down there. That's what we're arguing when we say we have a but-for share price. And again, we've chosen stamps.com because it's a very nice, it's a nice clean example. It really illustrates a dramatic drop. There's not sort of staggered drops over multiple disclosures. And it also gives you a sensible but-for price that's just about half the share price for the whole lifetime of the stock, or at least for the width of this graph. But what happens when your disclosure actually puts you in a not such a sensible position? So this is a different example. This is a company called Nectar Therapeutics, which produced some sort of marijuana product, I believe. There was a disclosure involving fraud sometime in June 2019, and there was a major change in the share price. We can sort of backcast. In this case, you can see that the dotted blue line goes on a bit beyond that sort of major share price change. There may have been multiple disclosures in this case. The important thing for the purposes of this section and what we're talking about here is just that there's been a major disclosure. There's a but-for counterfactual share price, that blue line. Going back, we're saying there was this much inflation prior to that disclosure date. And if you keep going back, until about November 2017, all of a sudden you're claiming implicitly that your counterfactual price, what the price should have been, is less than zero, which you arrive at via these sort of sensible sounding initial assumptions, which is that, okay, if there was, our share price for this is about $80 per share on the date of the disclosure, and it drops down to about $60 per share. There's, roughly $20 of inflation. But then if you go back in time and all of a sudden your share price is less than $20, you're getting below zero. So what can you do about this? What's a different way of getting a counterfactual share price that doesn't sort of put you in this hole? So we've presented two methods here, and the thing that I wanted to stress about these methods and this approach to sort of dealing with the negative share price is that these are in no way a jury rig. This is not some kind of quick fix. This is actually rather, we think, more economically robust than just doing a simple rote, okay, well, it dropped by 20 pounds. That means there was 20 pounds of inflation. Forgive me, dollars, I'm in London. So the two methods that we've demonstrated here, one is called percentage backcasting. So I don't know if I mentioned it before, but this method we've been talking about of doing a pre-disclosure counterfactual, you might call constant backcasting. That's where you just backcast the same constant size of the drop for the entire lifetime of the share price. But an alternative to that, which we think, again, is perhaps slightly more realistic and robust and which doesn't have the same below zero problem, is this percentage backcasting. So that's the line in green here. Now, percentage backcasting is instead of saying, okay, well, there was a drop from, X to Y, and therefore there was X minus Y to be backcasted, we simply say, what was the change in the percentage of, what was the percentage change in the share price? So if we lost, half our value, and instead of backcasting that same half value, we backcast 50%, and we say, okay, the share price was inflated by 50% over the lifetime of the whole share. The second approach that we've got in the red dotted line here is sort of a roughly similar thing. It's called linear dampening, and this is where we assume that the inflation of the share price due to the non-disclosure occurred sort of gradually, so that the fraud kind of crept into the share price rather than happening all at once. So here we just say from the first moment that there was ever a problem, or from the sort of original first part of the class period, there was zero damage, and then at the moment of the disclosure there was the full size of the drop. But for every point in between, there was just this gradually linearly increasing amount of distance between what the share price was and what it ought to have been had this information been disclosed. So this allows you to kind of make the rather intuitive and again, perhaps more economically robust even assertion that, well, it's not like there was the price didn't shoot up in response to some sort of secret event. It's just as investors bought and sold the stock, the fraud gradually inflated the price. So again, both these methods, you avoid your problem of negative share prices, you get a perhaps more realistic version of a counterfactual share price, and you can avoid the whole issue. But it's worth mentioning that these approaches are not actually that widespread yet. For the most part, a lot of courts are still relying on this constant backcasting, despite the issues you talked about. So that concludes the presentation. Thank you all for dialing in. Hopefully wasn't too much trouble with the delay from last week. And yeah, thank you again.